Hi, everyone. Welcome to our November market update. I hope you're having a great fall. I'm Valerie Leonard, CEO of EverThrive Financial Group. And this past month, I've spent a lot of time analyzing the markets, the economy, and the political environment. And today, I want to cover some topics that will help you know what to possibly expect for the remainder of fourth quarter and into 2023 and how it relates to your money. A quick note, thank you to everyone who has subscribed to our YouTube channel. As a reminder, by subscribing, you'll always be the first to know when we have new updates to share with you. So let's jump right in and get to the tough news first. In past months, we've talked about how the Federal Reserve has not believed we are in a recession, even though it felt like one to consumers and even to many experts. That's still the case. But more and more analysts are forecasting an official recession at the end of 2022 or early 2023. And the Federal Reserve raised rates again in October, which is what we expected. But it was the fourth consecutive rate hike of at least 0.75%. And the Fed is doing this to try and tame inflation. By raising rates, borrowing actually becomes more costly and it helps restrict growth here in the economy and thus fight inflation. And on Friday, November 10th, consumer prices were announced to have risen 7.7% in October. So CPI is how we measure inflation. It's sitting at 7.7% right now. While this is really what I was expecting, just kind of on my end, it really surprised the markets with just good news. Most investors weren't expecting that, and that led to a stock market rally. And the fact of the matter remains that we continue to face the dual headwinds of slowing growth combined with this sticky inflation that the Fed is fighting. And I suspect next month we will not see any significant declines in inflation, and it's probably going to hover around this mid 7% mark until first quarter of next year, where then it will likely drop to around 6.5% in my opinion. I'm optimistic that inflation will be under 5% by the end of second quarter of next year, but we'll have to wait and see. And 2023 is likely going to be a year of slow growth or maybe even zero or negative growth from a GDP standpoint because interest rates are expected to continue to increase. Now, when you look at GDP estimates going forward, and just a reminder, GDP measures the value of goods that people buy here in the United States. I believe that GDP is going to be, like I said, zero or maybe even turn negative in the first or second quarter of next year. Mortgage applications, for instance, are down about 41% since this time last year. And that's evidence that economic activity is going to be limited in the coming months due to the current interest rate environment. Now, since the interest rate is really the biggest driver of recessionary activity right now, continued rate hikes will slow the economy. And over the summer, some analysts thought that the Fed might begin to ease up on the quantitative tightening process that they have in place sometime in the fall. But Fed Chairman Jerome Powell recently stated that some pain is necessary to help fight inflation. But keep in mind that not everything is bad news. Right now, according to Fidelity Investments, there are about 1.6 job openings for every unemployed worker here in the United States. And the unemployment rate is what we refer to as a lagging indicator, which just means that unemployment typically doesn't start to increase until we're already in a recession. But still, the jobs market is very strong. And I believe if we officially don't see, or rather do see a recession called, there's probably a good chance that it will be short relative to historical standards, at least. So we'll continue to keep you up to date on this front, and we're always working behind the scenes to make sure that our clients' portfolios are appropriately managed within their risk tolerance profiles throughout really whatever conditions we're looking at. And for those of you that have a 401k account, I recommend that you assess how much risk you're taking and just make sure it's also in line with your needs and goals. From an investment standpoint, you'll likely be required to have patience in the coming year, and history tells us that those who have an appropriate strategy and stick with it typically do better in the long run. So if your emotions are running high right now, they're causing you to worry, please just reach out to us and let's have a conversation about what steps you may need to take next. With that said, let's zoom out the lens for a minute and talk about recessionary periods over time to help you understand the bigger picture. This chart shows recessions and market dips really going back over the last 50 years. So first off, you can see more green than red, which points to the fact that markets are positive more times than they're negative. That's good news, right? So if your accounts are down, just keep in mind that historically markets are up over the long run when you do have patience. Let's also look at the causes for these recessions. So in the early 70s, that's over on the left side of your screen, investors withstood the oil embargo, and the three red bars kind of in the middle of your screen are the dips from the tech bubble bursting and 9/11 happening at the same time. And then, of course, there is the 2008 crash from the great financial crisis, and then the pandemic impact at the right of your screen. But what about these other red blips around the arrow that I have pointing to here? These are recessionary periods in the early 1980s and again in the early 1990s, which were primarily due to tightening monetary policy, which is the same thing that is really happening today. So in a way, the goal here is to have some short-term pain to prevent longer-term problems. And you can see that periods of growth follow these dips from a historical perspective. Next, take a look at this beautiful quilt. Now, it looks hard to read. It may look intimidating to understand, but it's actually really quite simple. So the columns across the top represent each calendar year going back to 2011. And the colors of each box represent the major places you could choose to invest money. So historically, in order to build a diversified portfolio, you would have considered having a portion of your money in each one of these colors, or asset classes, as we refer to them to be a little bit more precise. So putting your money into a number of investment options that include different types of asset classes may help you reduce risk. And generally speaking, if your dollars are invested in materially different types of investments, so some in stocks, some in bonds, some in cash, maybe different sectors, that kind of thing, and market conditions cause one of your investments to decline, all of your money shouldn't be affected in the same way. So historically, investors who put their money in only one type of asset class, maybe say stocks, for instance, have been at an increased risk for loss of principal because their portfolio wasn't diversified. And here you can see how these major asset classes have performed. Over on the right-hand side, this goes through the end of last quarter. Commodities were the best performing category, followed by cash. Bonds were down about 14%. And then the worst performing category in the far bottom right-hand corner is large cap growth through the end of this last quarter. And since the end of the last quarter, there have been a few recent bright spots in the market too, with equity markets bouncing back in October. So the S&P 500 gained 8.1%, and the NASDAQ rose 3.94%. The Dow Jones Industrial Average experienced a really strong month with a surge of about 14%. So the indices remain down year to date, but the strong October will help offset total losses for the year. So while we have a more positive long-term view, we want to acknowledge some of the consumer impacts. Credit card debt has surged in 2022 with people borrowing more or turning to credit. And the personal savings rate has dropped significantly as well to 3% in July, which is, it was at 8.7% in December of 2021. And some of this is due to opportunity to spend on discretionary items like travel, but it's also due to inflation. And U.S. home sales have dropped for the 8th straight month. Since home sales are a big driver of economic activity, slowing home sales is concerning, and demand is starting to slow, and that just leads to slower growth. That brings us to some survival tips for you as an investor. We've included tips for people in employer-sponsored retirement plans, as well as people with actively managed investments. And of course, I want you to take another look at your risk tolerance. Just make sure you're not taking more risk than you're comfortable with. While some people may assume that slower growth means taking less risk, typically, I recommend the opposite approach if you can have a long-term focus. When markets are down, you potentially have the opportunity to buy while things are on sale. And this is good news for those of you that can have patience. As I mentioned earlier, we can help you reassess your risk tolerance if you have questions. Next, reconsider your mix of investments or those asset classes that we saw in that colorful chart. There are some sectors that do better in slower economies and may be less affected by recessions, particularly like utilities, for instance, or consumer staples or healthcare. And I also want to make a big point here. We have global inflation right now, not just here in the United States. So you may want to consider reducing or reallocating your international exposure to be in line with current conditions. Another thing that you can do, I mentioned this before, is to try and stay patient. Believe me, I know how hard this is to do right now, especially with conditions being as volatile as they've been and the polarized political environment we live in. But being patient actually is an action step, even if it doesn't feel like you're doing anything. So one way to have patience is to limit your news intake. With a 24-hour news cycle, we tend to hear the same news over and over and over and over, and this really just isn't all that helpful to us. So I know that markets are cyclical, and as we pointed out earlier, people who make rational decisions about investments and risk and stay in the market for the long run typically tend to do better than those who lose patience and make irrational decisions. Here's what we're watching over the next month. Historically, markets tend to underperform leading up to midterm elections, and then they outperform afterwards. So in 17 of the 19 midterms that we've seen since 1946, the market performed better in the 6 months following an election than it did in the 6 months leading up to it, despite some volatility around the day itself. We still likely won't know the outcome of the midterm elections until December 6th, but this is still important to keep in mind. If you looked at the markets the other day, right after the elections, the Dow closed down 600 points lower for the day, and it was just because of indecisive results. So you know that past performance, of course, is not a guarantee of future results from an investment standpoint, and we're contending with growth restrictions from rate hikes, like I've already mentioned. So there's still a lot of uncertainty, but it's just something to be aware of, that historical patterns sometimes come into play around political cycles. Second, it's corporate earnings season. And with a recession looming, corporate earnings become even more important to watch. And the corporate earnings reports will be one of the biggest factors driving whether or not there are further slides in the U.S. stock market. The markets did record a small gain mid-October after we saw better than expected earnings reports from large companies, with about half of companies reporting at that point at least. And then the third thing we're watching is the next Federal Reserve meeting. So the Fed has started to hint that they may begin easing up on the pace at which they are increasing rates at some point. And although it won't likely be at their December meeting, they're starting to talk about a light at the end of the tunnel more than they have at any prior point this year. So we're keeping a close watch on that as well. Before we sign off, I want to take a moment to give thanks. All of us at EverThrive are so very grateful for those clients who have chosen to work with us, including our individual clients and our 401k plan sponsors. And for all the people who have supported us over the years, we appreciate all of you. And we wish everyone a blessed and a happy Thanksgiving. Take care, reach out with any questions or concerns. Don't forget to subscribe to our YouTube channel, and we will see you again soon.